Hello everyone. The topic is mutual funds. We will learn meaning and definition of mutual fund, working of mutual fund, terms in mutual fund, types of mutual fund, advantages of mutual fund, pros and cons of mutual fund in this presentation. The meaning of mutual fund is that it is a trust which pools money from the investing public and invests the same in other avenues of investment such as stocks, bonds, etc., which is professionally managed by experts, and the gains thus earned are distributed to the fund investors in an equitable manner. The definition goes this way: a mutual fund is a professionally managed investment scheme, usually run by an asset management company, that brings together a group of people and invests their money in stocks, bonds, and other securities, and at the end, the profits thus earned are distributed to those fund investors, and the assets are managed by a company which is known as asset management company, which is filled in with financial experts, and they advise where the mutual fund has to invest if it wants to earn more profits. And one asset management company can function as AMC to only one mutual fund, which is prescribed by SEBI. This is how mutual fund works. Mutual fund collects money from the general public or the people who are wanting to grow their money through various schemes, and thus the mutual fund invest those money in various investment opportunities available in the market. It can be investing the money in shares, stocks, bonds, or much more opportunities that are available in the market. Thus, the investment made by the mutual fund will get some earnings in the future in the form of dividend, interest, or capital gain. If the mutual fund has invested in shares of stock, the mutual fund will earn dividend. If the mutual fund has invested in debentures, it will earn interest. Or if mutual fund sells the shares, it will earn capital gain. In all these cases, whatever the earnings has been made by the mutual fund, it will distribute those profits that are earned to the fund investors in an equitable and satisfactory manner. This is how mutual fund works. After learning the working of mutual funds, an individual investor has to understand certain terms in mutual funds. What are those terms? Come, let us see. Certain terms that are very technical in mutual funds. First being AMC. AMC means Asset Management Company, and this is the company which is going to be filled with financial experts and who do technical analysis, and who is going to advise the mutual funds where to invest to make the investment a profitable one. A mutual fund has one AMC which is going to advise them throughout their pursuit of profit in investments. Second, we have unit. A unit is a share of a mutual fund. Whenever an individual is investing in the mutual fund, he is investing in the unit of a mutual fund. It is something like a person buying a share of a company. When a person buys a share of a mutual fund, it is termed as a unit. And third, we have net asset value. The net asset value is the price of the unit of a fund. Each fund has a value, and when it is divided into units, that unit value of a fund is known as net asset value. And initially, the net asset value of the fund will be less. As time passes, as market progress, the net asset value keeps on increasing. Next, we have load. Load is the fee that is charged whenever an investor buys or sells a unit of fund in the mutual fund. Whenever a new investor buys or sells a unit in a mutual fund, he has to pay a certain amount of money, and that fee is called as a load. And we have NFO, a new fund offering. Whenever a mutual fund is going to offer a new mutual fund scheme we call it as NFO, and it is offered at NAV, which is termed as net asset value. The mutual funds are coming out with NFOs, that is new fund offerings, new schemes. The recent development is SIP, systematic investment plans, wherein the individual investor can invest periodically into the mutual fund schemes. He can invest an amount which is far lesser than 1000 rupees, and he can start investing for each month, wherein he has to commit putting into the similar fixed amount every month or every 3 months, so that his fund grows into a bigger corpus. Next, we have expense ratio. What is this expense ratio? Expense ratio is the percentage of fees paid to the mutual fund company to manage and operate the fund, including all administrative expenses. To be precise, expense ratio means something hidden, which the individual investor in mutual fund doesn't understand well. But be cautious to understand this. We know that mutual fund is going to take our money and invest that money in various other investment opportunities, and thus mutual fund is going to earn back some amount of profit, and thus mutual fund distribute all this profit that has been earned through those investments. If you ask this question, the mutual fund will say no. It is going to deduct some amount out of those profit that has been earned by the mutual fund as earnings, and this deduction of profits out of the earnings that has been made by the mutual fund investment is called as expense ratio, which is said to be the fees to be paid for managing the fund. And this expense ratio ranges from 1 to 3% of the fund value or the fund investment value itself. Hence, these are the terms which are to be understood by an individual investor in mutual funds. Moving on to the types of mutual funds, there were n number of mutual fund schemes available in the market which were only leading the investor into confusion. Thus, SEBI came in to help and gave a solution that there can be only 5 types of mutual funds in the market. What are those 5 types? It said equity funds, debt funds, hybrid funds, solution oriented funds, and others. What are these? Come, let us see one by one. First, we have equity funds. If the mutual fund is going to make investments in shares or stocks of other companies, then that will be termed as equity funds. In this case, risk is higher because it is linked to equity shares, but the benefit is double. It has return in the form of dividend as well as in the form of capital gain or capital growth. The second is debt funds. In this case, if the mutual fund is going to invest in debentures or bonds of other companies, we term it as debt funds, and this debt fund is less riskier and it has regular income in the form of interest being paid by the debenture of those companies. So it is advisable. Equity funds are for those people who are ready to take risk at a lower age, and debt funds are for those people who do not have regular income and they are not ready to take higher risk. And we have the third type called as hybrid funds. This is a mixture of equity fund plus debt fund, which will have both income as well as growth. The fourth, we have solution oriented funds. If individuals have certain desires, dreams according to their financial plans, they have to meet certain requirements in terms of finance in their future, say like child's marriage, child's education, etc. In such case, solution oriented funds are designed to suit their dreams and desires, where fund gets matured on that particular date and term. And the last, those funds which do not fall under these 4 categories come into the 5th category called as other funds, which are designed by the company for their own purpose to push in their sales and focusing on certain needs of the individuals. Such funds are called as other funds, and hence these are the types of mutual funds that are available broadly. Now, why an investor should choose mutual funds for his investment when there are n number of investment opportunities available in this market? It is because of the advantages of mutual funds. What are the advantages then? First, it is simple. Even a layman can invest in mutual funds. How? If one wants to invest in stock market, he should have knowledge of the stock market and he should know the strategies and he should implement certain strategies to make money in stock market. But the only one thing needed to invest in mutual fund is money, because rest of the things will be taken care by asset management company. Second, it offers diversity. If an investor is investing in stock market or in any other case, he will be investing in one single security or one single industry. But in mutual funds, the investment will spread across various companies, various securities and various industries as well. Hence, the kind of risk that will be there in mutual fund is very less. Third, it is going to offer versatility. There are types of mutual funds which is available which can be matched to the need of the individual investor. Hence, it is offering versatility. The fourth advantage is accessibility. Stock market is not accessible to every individual in the country, but mutual fund is accessible for two reasons. It is accessible in the knowledge base as well as in the fund base as well. To invest in stock market, one requires knowledge, and to invest in stock market, one requires huge amount of funds. But to invest in mutual funds, one, if has less knowledge, is enough. And the second thing, he can start his investment in mutual fund with less amount of fund. To a mere fund of 1000 rupees is enough to start investments in mutual funds. The fifth advantage of mutual fund is professional management. Whatever money is going to be managed by the mutual fund is going to be managed by professionals in finance or experts in finance called as AMC, Asset Management Company. Hence, they will take care of the professional management of our funds that is being invested in mutual funds. And last, the mutual fund is going to offer transparency of our investments that is being made through net asset value. What is the value of money that is being invested by us in the mutual funds today and tomorrow as well can be known through net asset value time and again. These are the advantages of mutual funds. Let us see what are the pros of mutual funds. It offers liquidity. An investor can liquidate his funds whenever he needs. It offers diversification across securities, companies and industry as well. It requires minimal investment, can be started from 1000 rupees as well. It offers professional management through asset management companies known as AMCs, and it offers variety of offerings through various types of mutual fund schemes matching individual needs. Hence, these are pros of mutual funds. Now, let us see the cons of mutual funds. Mutual funds charges high fees, commissions and other expenses which are always hidden to the investor. He gets to know only when he is getting returns from the mutual fund. There is large cash presence in the portfolio which is not being invested is a problem for the investor. Difficulty in comparing funds, be the comparison of funds within the company or funds with the different companies. Comparison is always a difficult thing in mutual funds. Hence, it is a problematic situation for the mutual fund investor, and lack of transparency in holdings of the mutual fund is a bigger problem for the mutual fund investors as a whole. Hence, these are the cons of mutual funds. We learned meaning and definition of mutual fund, working of mutual fund, terms in mutual fund, types of mutual fund, advantages of mutual fund, pros and cons of mutual fund in this presentation. Hope this presentation has given you little understanding towards the topic mutual funds. For further reading, please refer these books. Thanks for listening.